to another episode of GorillaCast. I'm happy to welcome Nat Burgess, managing partner of TechStrat, all the way from Seattle, Washington. Thanks for joining us, Nat.
Thank you for having me, Ami. It's really fun to be here.
Nat, can you tell us a little bit about your background in M&A and what TechStrat is doing?
Yeah, absolutely. So I met the Gorilla team 10 years ago now, just because we're operating in a similar environment. So been involved in technology M&A for over 30 years. I've done about 120 transactions now. But really, what got me into this business is probably similar to what got a lot of your portfolio founders into this business, which is curiosity about technology. So I went to the same high school as Bill Gates in Seattle. I was 12 years later, so computers had advanced quite a bit, but I was still working on a Timex Sinclair and a Commodore 64 and TRS-80s. And so you had to learn some programming to make them do anything. And that got me curious. And so in high school, I got very involved in that. Went and did a college degree, went to Wall Street, worked in New York and Tokyo for Morgan Stanley. So I got into the mergers and acquisition world, but technology M&A was not a thing yet. I mean, we were working on real companies like pharmaceuticals and manufacturing and extraction. But starting in the really 1990 to early 90s, it started to become a thing, a category. And I saw that. I got excited about it. I did an early internet startup called Postcard Software with a partner back in the early 90s. I worked for Activision doing multiplayer online games when that first became possible on the internet. I don't think early days of online gaming, it was dial-up point to point. And then the network just wasn't fast enough to support it. And then suddenly we could do it on the network, and it opened up this huge opportunity. And to me, that was really my first kind of lifting the veil and saying, this internet thing's actually going to be a thing. It's real. And so from there, I went back to banking, but with the technology focus. So starting around 1996, helped build up a boutique in the U.S., and then started my own about 10 years ago with some partners. And we are focused on helping early stage tech companies achieve an exit. We're not doing capital raise. We're not doing venture. We do a lot of work with private equity, as we'll discuss here later in the conversation, but really finding companies that are succeeding and executing well, and then helping them amplify their opportunity by making the most of the M&A opportunity. That's really our focus. And why am I here in Helsinki sitting with you? Basically, technology, it is a bit of a universal language. JavaScript is the same here as it is in the US. The interactions between companies, the integrations that happen, they cross borders. And so among the 120 deals I've worked on, at least 25 different countries now. I think 4 or 5 transactions here in Finland, several in Sweden, a lot in the sort of DACH region. So, of course, Germany was early. A little bit in the UK, although you can't walk across the street in the UK without tripping over a banker. So the competition's a little different. But I've really been working with entrepreneurs everywhere and lived in Europe in 2012 and spent a lot of time here, and have always found that this is a blue zone for startups. So your local community really punch above their weight. And so it's been exciting to maintain the connection and exciting to be here today talking with you.
Thanks very much, Nat. If we go back 10 to 15 years, it seemed to be the norm that when people were talking about startups, there were 2 distinct times. One was when an exciting startup was founded and it was starting its journey. And the second one was years later when they made a significant exit. And there was really no talk about the grind in between and what happens in these startup companies. It was so sexy. You found a company, you exit with high valuation, and now you're a millionaire. Now, if we look at today, it seems that more and more of the focus in the discussion goes into the funding rounds and how much money different companies are raising and so forth. And I think we have kind of lost a little bit of focus on understanding what an exit really is and what does a company need in order to be able to do a successful exit. And that's why we're extremely happy to welcome you to the show today and really get into the nuts and bolts of what does an exit event look like and what is required of a company to achieve that. But if we start a little bit from kind of the founder point of view, the founder perspective, you work with a lot of companies that have done exits. What are some of the common traits for the founders that have successfully sold their companies?
Yeah, good context and good question. Over dinner last night, we were discussing this question, and I recently invested in a company that was founded by a Navy SEAL. And it turns out someone who's been in those kinds of specialized military units has some capabilities that most people don't have that are perfectly suited to this kind of work. Mm-hmm. And that is, one thing is they're aware that they won't have a perfect plan before they start to execute. Perfection definitely blocks progress for a lot of us, myself included. There's this discomfort with starting to put effort into something unless you absolutely know that you got it right and it's perfect. And frankly, all the advice we get doesn't necessarily help. Mm-hmm. You got to think about that, and you can't do that. Like the classic YouTube headlines, 10 reasons you'll fail unless you do this, and this. But let's also remember that you're placing bets on people who have very little actual experience in the world, right? Yeah. Why is it that this band of sort of 20 to 35-year-olds is charged with doing all the innovation and risk-taking, being mentored and advised by people in their 50s? Well, there's something there. There's a boldness and a willingness to go outside of the comfort zone, or maybe a lack of sort of ingrained conviction that, it has to be this way or it doesn't work. And so I think there is, point being, among a younger generation that's ambitious and aggressive and smart, there's a willingness to move ahead even if it doesn't perfectly match prior patterns. And going back to your question, a founder that can be confident enough to go and to build a team and to build support for a direction and get everyone on the same mission as you would in a military context, knowing that they've only got 80% of the problem solved. To me, that's the key. Mm-hmm. That's where you don't know, like Muhammad Ali, everyone has a plan until they get punched in the nose. You got to get out there and get turned down by 100 customers, or, fail to hire people because there's some aspect of your business that they're not comfortable with. You got to get out there and start grinding and working. And then that last 20%, if you're persistent and determined and smart, you figure it out. And maybe that shift makes you look like a pretty different company, but you can become a successful company. So that, it's a bit of a ramble, but coming back to your question, what are the characteristics of a founder who's going to succeed? To me, that is maybe the most important one. The confidence to know that you've got enough pieces in place to charge ahead, and then the determination to figure out the rest of it as you go in the context of the real market.
Mm-hmm. Sounds very logical, and I do think that as you mentioned, being able to make decisions with limited information is one of those things for early stage companies that's really crucial, because you just don't have the resources to get all the answers.
True.
So you need to use what you have. And I also think from what you were saying, and one of the things we discuss a lot internally as well, is about first-time founders versus second-time founders versus third-time founders. How does that dynamic operate? And I think one of the benefits for first-time founders is that because they don't know what they are facing, then they will have the strength to carry on. Oftentimes you hear from people that, had I known what I'm getting into,
so let me,
I probably wouldn't have.
I after our first daughter was born, my wife basically said, I'm never letting you do that to me again. We have 3 kids now.
But that's how it oftentimes works. Another interesting thing is when a company.
Can I interrupt you just for a second? So you started to touch on something that's really interesting to me, which is who's more likely to succeed, the first, second, third-time founder. There are a lot of founders out there who are technically first-time founders, but it didn't really work. And now they're still a founder and they still have a company. And that company, maybe it's kind of started to figure out a direction, like something, there's something there, but their capital structure doesn't allow them to pursue it because they've got expectations built around a failed business model. And what do you do with, I mean, let me ask you, what do you do with that person? How do you think about that situation? I'm just curious because it's Harvard Business School says, most founders fail 4 times and then they succeed.
Yeah.
And this idea of you raise money, it doesn't work, you raise money, it doesn't work. But there are a lot of companies out there that raise money and it kind of sort of worked, but not really. And now everyone's tired and their existing investors are fatigued. And is that a target for you? Do you think about
Yeah,
those
well, I think that's a really, really critical and interesting question. And I think we have to kind of tackle it from 2 directions. One is, what do you do when that has already happened?
Mm-hmm.
And I think the other way of looking at it is, well, how do you prevent that from happening? And I think one of the structural challenges in the market today that we see is that a lot of companies are founded with the expectation of becoming a unicorn. And they raise money and they build their business based on that. That's the only target that we have. Now, having said that, every company needs to become a 20 million euro company first. And the way we're looking at it is that no matter what your end goal is, you should build smartly until you hit that 20 million, 30 million, 40 million, whatever the mark is. Get there first without jeopardizing your cap table, without raising too much capital, without putting too many nooses around your neck. And once you're there, then you can think, well, is this the time for us to exit, or is this the time when we kind of really get into the scaling and start building towards that unicorn status company? I think a lot of the companies are in the situation that you mentioned because they have raised too much money early on. And now, as you said, the cap table doesn't work. Even if you do a meaningful exit, it's not going to do you any good because there are liquidation preferences. There are people who are going to get their money before you ever touch any of it. So I think the long-term answer is we need to start looking at building businesses differently. Be more patient in the beginning. Show that you can do this first. And once you have shown that, then you can start taking in more capital and being more aggressive with your buildup.
Yeah.
Now, if you are already in that situation where you've raised a lot of money, the business model didn't work, you've pivoted and you've found that you can still build a reasonably good business, that's the hard part, and there's no easy answer for that. I think the cases that we have seen and what tends to happen in the market is that those people who have been putting in the most money early on, they just kind of have to write it off. Because if something structurally different doesn't happen, you're not going to get anything out of this anyway. And then you need to kind of start afresh and try to fix the cap table and find the types of investors that would be suitable for the new direction that you've taken.
Yeah, that makes sense.
Yeah. Great point, and I think it's one of the situations that we run into more and more today. And if we look at the market today and we compare it to the market 5 to 10 years ago, raising money was a lot easier then. You were able to get good valuations, you were able to get big money, and now when the market has kind of balanced itself, if you have raised with great valuation 2 to 3 years ago, it might be really hindering your progress today because those valuations are no longer there. So, so it is a very, very interesting situation. And that brings us kind of to the point that it's an interesting dynamic when you start a company and you raise some venture funding. Essentially, you're promising an exit to your investors. And for investors and for yourself, it's important to know, well, if this business succeeds the way we are looking for it to succeed, what does the exit look like? Who's going to be likely to buy you and so forth? And at the same time, it feels kind of counterintuitive in the early stages where you haven't proved anything to even think about exit. So what would be your advice for founders? How should they be looking at the exit scene early on in their journey? What makes sense? What doesn't make sense?
Yeah, we think a lot about that. And I could probably give you a 5-hour answer and still not cover all the situations we've run into or ways we think about that. But let me this also relates to something you said earlier about how, we start a company, there's a headline, we exit, there's a headline, what happens in the middle? Yeah. And for decades, what happens in the middle in the private equity level of investing, where they're coming in and they're building $50, $100, $200 million platforms, what happens in the middle has been very well understood and orchestrated. And I remember working on a deal with Vista Equity Partners back in 2000. 2003. Yeah, 22 years ago. So they were 3 guys and a small fund at the time. We did their third deal. They're now 220 people and 30 billion under management. But even at the time, 22 years ago, they had a playbook. They came into companies and they said, we understand how to build, at the time it was how to transition to subscription revenue. We understand how to put the right CMO in place. We understand how to create a go-to-market motion that's repeatable. Literally, even then, with a relatively early stage fund, at that level of investment with those resources, they could effectively script the company, and they would know from day one who the 5 acquirers were going to be. So the deal I worked on with them was a advanced planning accounting plugin software. At the time, that was relatively new. And they knew that it would sell to Business Objects or Oracle or one of the ERPs or IFS or kind of a short list. And sure enough, it sold to Business Objects. But they came in there with the playbook. They rearranged the people, they hired new people, and they built the company. And so they knew what that exit would look like. Contrast that with VC, and no offense to the VCs, but they were often the ones who were going to outsmart the market. They knew something no one else did, or they would be attracted to an investment for some reason that appealed to them but wasn't part of any playbook. And it worked enough, and it works enough that it appears to work from the outside looking in. However, we all know that the majority of them actually don't work. And the problem and the challenge with that early stage is you can't really have a playbook because often you're trying to build something new. You're looking for white space and you're looking for a new way to address it. And so you can't script it, or you effectively just kind of kill the value and momentum of the company. But that said, I still think it's really healthy for founders to think hard about, what's my company going to look like in a year, 2 years, 3 years? What's the champagne toast that we're all drinking where we say, yeah, we did that, we built that. And at that point, who does it have value to? And that tends to give you industry categories, and those categories tend to have market valuations associated with them, peer groups across public markets, recent exits. Are they valued on ARR multiples? Are they valued on EBITDA multiples? Are they valued on margin? Are they valued on growth? And what are the values in those categories? So growing towards an exit in a category that can support a good valuation is a critical thing. And then the second point of that for founders, which is not always obvious and definitely uncomfortable for many, is if I know my category or categories, and I know the 5 or 10 companies that are most likely going to be my targets, how can I get to know them? How can I create an opportunity for some kind of a joint venture, distribution, partnership, collaboration? Maybe I bring them a client. How amazing is that? And really get their attention. But how can I make an effort over time to get to know them so that I can build towards an exit? And that's another, again, I love talking about this, and I love talking about it with someone who builds companies because we kind of share that journey. But deals happen when people decide they want to work together. Like they find that alignment, they're on a shared mission. You can't discover that unless you're figuring out a way to be in the same room with them and work with them. So there are plenty of stories of companies that wanted to be acquired by Microsoft, and they were based in London or wherever, and they opened an office in Seattle and started walking the halls and meeting the people and getting to know them. And surprise, a year later, there's a deal. So
that's really interesting. And I think one of the things, just to add to that, which I kind of learned almost 20 years ago when I was doing my MBA in Atlanta, I had a great entrepreneurship professor who had built and sold nine different businesses, and I was fortunate enough to be his teaching assistant in a new course that he was teaching called Advanced Entrepreneurship. So majority of the entrepreneurship courses would be students coming in, building their business plan, thinking about what type of business they're going to build. Whereas this advanced entrepreneurship was kind of reversed. We started the first class by handing out a business plan to teams. And the whole point of the course was to analyze different phases of the company. For every class, we would get a curveball in them building the business according to the plan. And they would have to think about, well, what would we do in this situation? How would we handle this? How would we pivot, or how would we stick the course, and what would we do? And then the last class was they got a buyout offer from a company within the industry, and they were asked to analyze if they would take the deal. And every team in the class decided to turn down the deal because based on their calculation, the value of the company was higher.
And yet here you are as basically a VC all these years later. How did that happen?
And Charlie was making the point in that last class is that you shouldn't be thinking about theoretically how much the company is worth. You should be thinking about what's enough for me. If you would get life-changing money in this scenario, would you risk maybe getting a little bit more by moving ahead? And I think that was really a question that stopped a lot of people in the class, myself, for sure, to think about that it's all fun and games in theory, and you can always talk about value in theory. But when you are actually faced with these decisions, that's probably very different. And I would assume that as an M&A advisor, you run into these discussions oftentimes with the people you're working with.
First of all, I'm just really impressed that your professor had the experience and wisdom to make that a core element of the course, because it's, it's tough. I think it was Rothschilds who famously said, I made my fortune by always selling too early. But if that's your operating mode, then you may never get very far either. So it's a balance. But and as the banker, as the advisor with fees associated with a deal, I'm almost expected to encourage people to take the offer. Because I could move on to the next one. But frankly, we're highly, highly motivated to see a much bigger deal in the future because it's better for everyone. So we try to be balanced in that. But we have a situation right now, which I think is a great example of this, where we ran a process. We got 2 offers. Our client took the high one. We were pretty cautious about it. That's a bidder. We had done deals with them before, but we thought execution risk was high. We just weren't convinced that they were going to follow through. But it was a higher offer, and I remember the board basically concluded we have a fiduciary duty to our shareholders to take the high offer. And I was thinking, you do, but so anyway, that offer faded. 2.5 weeks into diligence, they pulled the rug out. We went back to the second bidder. This is happening in real time. I actually have a call, but we just got a revised offer yesterday from the second bidder. So second bidder came back, and initially they were in the first round, they were about $1.5 million below the high offer. Now they're about $3 million below the high offer. But this resonates with what you just said, which is, what's the value of the company? It's not what I think it is. It's not what some sort of uninformed and aggressive drive-by offer indicated it is. It's what we can execute against. That doesn't mean we have to do it, but it means we just have to be realistic about that. We ran a robust, complete process. We know what the company's worth now. We'll have a board call next week, and we will advise them to take this offer and to move on, because that other one doesn't mean anything anymore. It doesn't mean anything. And we have another situation in the U.S., company that was competing with Wiz. Wiz just got acquired for 6.7. I'm not going to get the number. Many billions of dollars, 250x return to Index Ventures. Very hot area, cybersecurity, scrubbing, cloud infrastructure, change anomaly detection, kind of like what we used to do for networks, but for cloud. Very topical, on point. This other company that was trying to compete with them never really got traction, was outspent in the marketing. And now they're sitting there saying, are we worth $6 billion as well? No, probably not. Are there companies out there that bid on Wiz and didn't win who might want a solution? Maybe. And so we've got to work within the context of what's possible. It's not a unicorn exit. It's going to be a pretty rational exit.
Yeah. No, but that's brings up a couple of topics I want to dive deeper into, and the first one, I'll come back to the second one, which is what you said previously, that as an M&A advisor, inherently it's expected that you would advise people to take a deal, but sometimes you don't. So it would be really interesting to hear a little bit more about what are some of those scenarios where you see that raising another round and doing an exit later, a much larger exit, would make sense. But prior to getting to that, I also want to talk about this kind of exit valuation part, because one of the things that we often run into in this space is that some of the funding round valuations are just completely absurd. And one of the things that we often like to tell the founders is that the only valuation that really matters is the exit valuation. What you get in paper valuations doesn't really matter. So how do you see this trend between funding round paper valuations and what the actual exit values are when you're doing deals?
It's definitely a really important question, and a founder can feel pretty lucky and proud to get that giant VC offer, and they've worked hard for it, and it is a validation. But man, it can be a trap too. I mentioned on the walk here, and again, my day job is M&A, but I do a fair amount of investing as well. So I was in a safe that the company just did a Series B at a $320 million post money, and they need $1 billion exit now. Yeah. So on the one hand, I'm proud of the team and they've earned it and they're executing well. On the other hand, that's a pretty high bar to reach. And so I would agree with what you said, which is it's really the exit value that matters. And this one's a little harder to talk about without getting sideways with half the industry, but there's really a different perspective and maybe a different level of sophistication depending on who you're pitching. If you're pitching an M&A acquirer, a corp dev team at Cisco or Microsoft or somewhere, they are very sophisticated and they're very realistic. They're trying to build a business. They're trying to grow earnings. They're trying to avoid getting beaten in different market segments. They need product, but ultimately they're going to have a knowledge of the market. And one of the things that I hear again and again, if I'm pitching a deal to that category of buyer, their response is going to be, are customers really going to buy that? I've never heard a VC ask that question. Yeah. I mean, I'm sure they do. No offense to the VCs, but that corp dev, sophisticated acquirer audience is going to be a tough sell, and they're going to be very realistic, and they're going to base a valuation on what they genuinely have support within their organization to do with that asset. Whereas an investor, especially angel friends and family type investor, but even the smaller VCs, they can often get pretty excited about a market vision that may not be possible in any universe. Yeah. But it sounds good. It's a good narrative. It sounds strong. And this is actually one of the reasons why I really appreciate our partnership with Gorilla Capital, is because you are so organized about how you think about these companies and the signals of success, the potential of failure, and the decision criteria, where you're making a decision based on sound analysis and the actual opportunity as opposed to the fantasy of what could be. A charismatic founder who can spin up a really powerful, exciting story can probably raise money up to a certain level, but they're going to hit a ceiling in what they can do in the market, and they're going to be overvalued, and then they won't have an exit. So having that discipline early on to say what's actually most likely to happen here, not what could happen, it could be great, but what's probably going to happen, and do we have the capital structure and the organizational structure to address that and to create a win for everyone involved. That's a pretty sober conversation, and it doesn't lead to that unicorn valuation. It leads to a capital base that's enough to get there. As an M&A advisor, I love that, because now I can come into a situation, and instead of everyone looking at me and saying, please sell us for $1 billion so we can all ascend to heaven together. Like, that'll never happen. Sorry, guys. But there is a 20 to 50, and we'll work as hard as we can to get it close to 50. And you have a capital structure that makes everyone money at 20, 25. Great. We can work with that.
Yeah. I appreciate the answer, and I also want to emphasize that I think our goal is not to say that one thing is good, another thing is bad. These things always depend on a number of factors, but I do think that it is an important discussion to have, because at least we don't hear that discussion often enough. It's usually you don't think about the ramifications of the round that you raise and where the bar is set for you afterwards. You're just excited that the money is coming in and you get to build further. And also this, as you said, that putting the critical time to think about what is actually realistic and what's not. I think that's one of the things that a lot of people can gain something from.
Yeah.
Whatever you decide after that doesn't matter. The mere thing that you go through the thought process and you've thought about this and you've taken it into consideration in your decision making, that's great. So now I want to circle back to the thing that I mentioned. As said, that when you get a company coming in who's considering doing an exit or raising another round, can you think of some examples where, kind of from your point of view, it has made sense for the companies to push a little bit further, and what are some of those things that you see that make you kind of recommend that path?
Yeah, no, it's a question that we have to think about every time an offer comes together, and I really try to boil it. I try to simplify it. So, what I ask myself and what our team considers is always, how much more value can we create in the next 12 months, 24 months, 36 months, realistically, not moonshot, everything aligns. How much value can we create? And there are two elements to that answer. The first is, how much scale are we going to gain? How much more profitable are we going to get? How many more customers are we going to get? What new sort of high-profile product releases are we going to get out the door? What value are we going to create? And then the second part of the question is, how is our competitive environment going to change for us or against us? And, pro tip, it's always against you. And on the value creation side, we had one situation, about a $20 million revenue business in the U.S., where we were working on an exit. We had a couple of offers, and they were okay. And frankly, for this company, they would have let the founders retire comfortably. It was okay. But we also had an opportunity to acquire a small division of a large public company. And that acquisition, it only added about 20% revenue, but it gave them a lead funnel from one of the largest fuel companies in the world. I mean, you look at our tombstones, you'll know who I'm talking about. So I don't want to go too deep into the details, but we pretty quickly reached the conclusion of, we can create a tremendous amount of value by landing that acquisition, even though it only bumps our revenue by 20%. It's kind of neutral from an EV standpoint. If we look at an immediate exit, it's going to give us a lead funnel and momentum, and we'll have a press release where every PE in the world is saying, who are these guys and can we get on this program? And so we decided to go execute on that. It took a while. It took almost a year to get it done, but it was announced a couple of weeks ago. And so now we have a company that has all the attributes they had before, plus the additional revenue and customers that came from the acquisition, plus this strategic relationship that's creating a lead funnel, and the perceived momentum of having closed a significant in our market acquisition. And the math, we haven't sold it yet because we haven't started our process yet, but I'm very confident that we're going to see maybe a 50% lift in value. So that's an example where it made sense to wait and to execute and to build more value. And we had the kind of resources and momentum to do that. But there are plenty of other situations where we're sitting with the board and with managers, and we're talking about taking an offer now versus later. And as soon as the board or the CEO or the leading shareholders, as soon as anyone starts engaging in any kind of magical thinking, like, oh, this could happen. What if that happens? What if this customer we've been talking to for 3 years finally signs the big contract. And as soon as I hear that, I think nobody's going to save you.
Yeah.
Right? This is about what can we do? What can we do together? Not can we like hang around the hoop until something, or hang around the net. What do you call it in hockey? Hang around and hope something good happens so that suddenly everything works out. Because normally what we're solving for is we have an exit it's not thrilling for everyone. It may be okay for some, it may be terrible for some, but it's kind of what we can do right now in this time. And that hard conversation where, sorry, this isn't going to work out as we expected, but it's the best we can do right now. That's a conversation that has to happen at a certain point. And, a young first-time founder who's really eager to make sure they do the best they can for their investors doesn't want to have that conversation. And some coaching and some help there is useful. And frankly, as the M&A advisor, we often become their voice, where we're effectively putting together what looks like a fairness opinion, but it's just a sober analysis of here's where we are, here's what's likely going to happen over the next year. Based on what we have on the table right now, everyone's best served if we do this deal.
No, that's great. And I kind of want to bring up one point here, which we often talk about in our environment with Gorilla, because as you know, we're investing in capital efficient businesses, and one of the criteria that we have is that we want to find businesses that are looking to break even as quickly as possible. And I think when it comes to M&A, the timing is always critical. So if you are cash flow positive, if you are in control of the destiny of your own company, then you can look for the perfect timing for the transaction as well. But if you are between the rock and the hard place, that either I sell now or I need to raise a significant amount of additional money, it makes the situation a lot more hectic, and I would assume more difficult for you to work with as well.
Yeah. There's a reason why the first or second question that we'll ask when we get that inbound call is, how much runway do you have?
Yeah.
And if the answer is we have to sell in the next 30 days, then there's not much we can do. If it's 9 months, there may be a little bit, but we're still clearly, if it's 9 months, we're still on a path that's not going to lead to self-sufficiency or being self-sustained. So, I think, and there's only so much sacrifice that a founder and a team can make before it's kind of unfair to them as well. So I recently read the Bill Gates autobiography, and kind of one of these funny real-world stories. My dad was his English teacher and took a lot of the famous photos of Bill Gates. So when he published his autobiography, he reached out and asked for permission to use some of those photos in the book, and then he sent me a copy, and that was my reading coming over here. But when they started that business as, I think, 4 partners, they agreed to pay themselves a very minimal wage. And that was it. And they had an operating agreement that said, we're just going to get paid almost nothing, and we're going to build value in the business. And they set on that. This was before VC really existed. And they set on that path, and they were break even on almost no revenue, a couple of small license deals. They owed some lawyers some money. They got caught up on that. But they were so capital efficient. And they were capital efficient partly because they were at the right place at the right time, but also because they agreed among themselves, we're here to build business value. We're not here to make money now. And the rest is history. I think that instinct carried them through. So,
absolutely. Now, one of the things that I want to touch upon, and it's worth mentioning, we had a lot of discussion topics that we could go into. No way we're going to cover all of them today, so hopefully we get to continue this discussion at a later date. But one of the things that I want to still dive into is for the listeners and for the founders to talk a little bit about the M&A transaction path. What typically happens when you engage with a client for a transaction?
There's two rough buckets. So a lot of our companies come to us and they've already been approached. So they have someone at the table who's interested in buying them. A lot of them come to us and they've reached a stage where it's appropriate to sell because they've recognized that they've kind of done what they can on the capital and with the team they have. So in the first situation where they've been approached, our advice has changed over time. So in a seller's market like what we had up until 2022, we would generally be pretty aggressive, and we would basically tell the buyer, we're flattered. We have multiple shareholders. We have to protect everyone's interest here. So, we'll talk to the board and decide whether to run a process, which is very different from saying we'll engage with you to try to make a deal. And in a seller's market, that's probably a safer bet than in a buyer's market.
Yeah.
We're in a buyer's market now. Yeah. And when that approach comes in, the approach itself is kind of a unicorn in many cases. There's one, especially if it's a strategic. I mean, if it's one of the kind of consolidators that's running around making offers on everything, you can take it with a grain of salt. But if it's a real company that could pay a premium, our advice now is take it seriously, lean into it. Don't dismiss it out of hand. Don't play games. It's a binary decision. I'm going to engage and try to make something happen, or I'm going to stick to my knitting and keep building the company. But I'm not going to play this kind of this sort of push me, pull you dance. So when they've been approached, that's our current stance, is take it seriously and make a decision. I'm going to make this deal or I'm going to keep building. For the other ones where we actually have to go from a standing start, we'd like to get to know companies over a period of time, but we do a quick analysis of who are the potential buyers, what are the recent transactions, what's the probable valuation range, and then a quick kind of a vendor due diligence run through of what are some of the things that might tip over a transaction here. Do they have clear chain of IP title? Do they have a lot of tech debt? Do they have a product on a platform that's appropriate for the buyers that might want to get them and integrate them? What does the team look like? Is it a high value team that would interview into these buyers successfully absent the transaction, or are they, do they not fit? And we take all those considerations, almost like a preview of the entire process of picking the partners, building out the offering docs, going to market, pitching it, getting into due diligence, getting to close. We think, okay, where are we going to tip over along this path? And if there are problems that are easy to fix, we advise them on fixing them. Otherwise, it's a go. Let's go make it happen. Yeah. But it's almost like that. It's almost like a race driver. They walk the track, and then they can sit there with their eyes closed and they can visualize running the entire race. I mean, that's kind of what we do when we think about these.
Yeah. And on that note, usually when you dig deep into the company and when you start going through the process, in general, what would be some of the areas where the founders would oftentimes have too rosy glasses on, or where do they view things differently from your analysis?
So one of the behaviors of a founder that makes us nervous is when they are aspiring to a valuation because of their capital structure rather than what the market will bear, which is a natural desire to take care of the people who've supported you. Yeah. But if it's irrational, then it's not going to work. Yeah. And so if that starts to happen, then we try to bring in more independent view of valuation based on data. So it's just data. Yeah. You may not like this, but here's what the data says. And if we can share that with the investors and the board and the management team, we can start to get alignment around what's possible. Another element of the rosy glasses is it's natural to be proud of what you've built. Sometimes people are too eager to assume that could be scaled up to Google scale and not break. Yeah. But surprise, it'll break. So how scalable is it? Is it something that would have to be redone using the architecture you figured out? So trying to help them be realistic about that. And then we can get down and, I mean, there's so many different things, but another one is just basic, accounting, revenue recognition. And in the US, our revenue recognition rules have changed pretty dramatically. Yeah. And so we'll have founders who sort of barely understand how that all works and are very confident they're doing it right. Yeah. When in fact, Microsoft's not doing it right. Trying to help them understand, be realistic about that. And then the final thing also, I mean, again, just a lot of pattern recognition over 30 years, but alignment. Is that founder standing with a team supported by shareholders and a board who are all moving in the same direction? Because if they're not, that's going to break things apart later. Mm-hmm.
Very good. We a little bit touched upon this from a different angle previously, but if you're looking for an exit to private equity or strategic buyers today, how do they look at things, and what's the difference between the two?
Our experience over the last 30 years has always been diligence with a strategic is a lot more fun because they find good things. They find synergies. They find elements of a product that they were not aware of, and they say, oh, wow, you did that. That's really cool. So you have people coming in and looking at strategic fit and opportunity, and you get to a premium valuation. That's one of the reasons. Whereas doing diligence with a private equity buyer, it's painful because all they're doing is looking for stuff that's wrong that they can use to bring the price down. And what's changed over the last really maybe 10 years is that private equity rigor of grinding you on churn and retention and financial metrics. Even if you're tiny and you only have 10 customers, like you're doing ARR analysis, and it's ridiculous because they're going to bring 100 customers and 10x your revenue anyway. So do we really need to lose 15% of our value based on this metric or whatever? Well, the answer is yes. That's how they're playing the game now, and it's fatiguing as hell. It's just but it's how it's the playbook, and it made sense when you're buying a $100 million business. Now they're applying it to a $2 million business. So you have to come ready to play that game, which means you have to be on top of those metrics and numbers and be ready to negotiate at that level, even though it feels a little bit like it doesn't make sense.
Yeah. Now, you mentioned previously, and it's pretty clear, if there is a market today, it is a buyer's market. We don't have crystal balls, but how do you see the market evolving here 2 to 3 years down the line?
Yeah, obviously we think about that quite a bit. And historically, we've always tracked the public markets. We've tracked the IPOs. We've tracked deals. But if there's one metric that is a better forecaster of tech M&A than any other, it's human resource demand. So huge wave of layoffs in starting second half of 2022, increasing 2023, decreasing slightly 2024, but still very prevalent. So I think like the tech layoffs in the U.S. that were flagged were over 250,000 in 24. They're 150,000 or 23, 150,000, 24, but still net shedding of talent, but at a decreasing pace. And the reason this becomes important in M&A deals is if a company's on a hiring freeze or they're supposed to downsize, they're not going to go buy a company that adds 30 people without maybe shedding 30 people or finding that same amount of budget to cut elsewhere. And that's a part of our negotiations now, and it's relatively new to me. But we closed a deal with a large public company a couple of years ago, and I won't disclose the valuation, but it was between 50 and 100 million. And to get final approval from the CFO, the operating division that bought our client had to go and find enough budget to pick up the OpEx to cover the deal. So they had to pay for it themselves, basically, out of their own operations, which is kind of logical, but also it meant they had to be really committed. Yeah. So HR is a pretty critical one. The IPO market is one that we should be paying attention to because it matters less than it used to, but it's still, as we think about how the modern industry works and these companies sort of get sold up the food chain until they're big enough to go public, unless you can top them out somewhere and take them public, gradually the whole system starts to get kind of backed up and the demand at the bottom of the funnel reduces. So we need the IPOs. And the IPOs were up slightly last year. So again, there's a little bit of a positive signaling there. And then the third thing is we gotten a lot of things have happened in the last couple of years that should have completely tipped over our market and our opportunity. Wars and interest rates and, just plenty of dynamics. And we've survived that. This is a pretty resilient economic, knock on wood.
Yeah.
Where's some wood, man? Pretty resilient economy that we're operating in. And so having absorbed all that and still to some extent thriving, I think that's encouraging. And then the last thing is just if you're investing in companies that you're building, everyone's in competition, they're suffering, the weak are starting to fall off. That's a great time to be building companies it's a tough time to be selling companies, but we're finding deals we can work on and add value and get them done. But man, great time to be building companies.
Yeah. And on that note, we'll start closing down our today's session. I would still kind of ask you to, based on everything that you've said, and there's been a lot of gold nuggets there. Advice to founders: what can the founders do today to prepare for a great exit later?
Yeah, I mean, there's a lot of technical elements that are fairly dry in that, and getting some advice around formation and making sure your capital structure is rational and helpful, doesn't just serve the interest of one investor, all of that stuff. Getting good advice on that, being around people who know that stuff, that's just important. But there's something that's more qualitative that I think about a lot. And I think you may have a similar instinct. If I walk into a room and I'm with a founder and 3 or 4 people who work for them, my opinion of that founder is almost shaped more by the people around them than by them.
Yeah.
So that ability to build a team of people who are maybe smarter than they are.
Yeah.
People who are conscientious and driven, not rock stars, because that doesn't help anybody.
Yeah.
But just solid, smart, committed people who are on the same mission. To me, that's a testament to the founder. That's an indicator of success. And this is a bigger thing than just companies as well. One thing I realized when I was helping my kids pick schools to go to was, yeah, it's great to meet the teachers, but can I please spend some time with the students? I want to know who else is going to be their peers. And if I think about my own career, what a gift to make so many friends along the way by having a chance to work with really smart, driven people and getting to know them and go through these adventures together. And that's probably what we'll be thinking about when we're on a beach somewhere sipping daiquiris, right? It's like the people and the adventures and the motion. But we have a chance to some extent to select those teams and to select our peers and figure out who we're going to be successful with. And I feel like that's a lifelong project. But going back to your question, who else is in the room?
Yeah, that's a great piece of advice. Now, we have 2 closing questions that we always ask, given the fact that the whole purpose of our podcast is to help people with learning. So the first question is, what do you know now that you wish you had known years ago?
We're all going to die. You and I might disagree about things, but in 30 years, we'll be dead, and who cares? So as a younger person, I don't care anymore. Yeah. But it took me a long time to get there. Yeah. But as a mid-20s, arrogant, up-and-coming executive wanting to succeed, I didn't really have that perspective as much as I should have. As in, it's okay that we disagree. Yeah. It's not a zero-sum game. You don't have to lose so I can win. But I can still be confident in my own opinion and my own direction, and I can execute on that and make it happen. And I've had friends who've had near-death experiences, and they were changed. Suddenly they had that perspective of today's a gift, I'm going to make it good, as opposed to, that is one thing. It comes with maturity, hopefully anyway. But if it comes earlier, man, you're better off.
Yeah, that's powerful stuff. Then the second question, really having to do with learning, that what could have helped you move faster on your learning curve when you look back at your career and professional development?
I kind of hinted at this earlier when I talked about sometimes you need to go when you only have 80% of the plan. Yeah. So a bias towards action and being bold. Yeah. Perfection can definitely get in the way of progress. And if you're pretty confident and you figured out a direction, sometimes you just need to go. Yeah. And you get a sense of people. Are they in motion? Are they moving towards a goal? Are they going to succeed? And those signals come from that bias towards action. And guess what? Customers, they have that same filter. If they see a company that's tentatively offering something that might work, they're like, call us when you perfect it. But if they see a company that's moving and selling to their competitors, they're going to feel like, I better buy from these guys. I better make it happen. So I think that bias towards action, that willingness to go before it's perfect, I think is really, really powerful.
All right. Thank you very much. It was great having you here, Nat. Much
Wonderful
appreciated.
opportunity for me as well. Thank you, Ami.
Thanks.